Nimish Joshi, investment analyst at CLSA, joins us now from the sidelines of the CLSA India Forum. Nimish, thanks for chatting with us here on ET Now. The IT sector has seen substantial earnings upgrade. Do you expect further improvement in the second half of this financial year? And more importantly, is it likely to be homogeneous?
I think more than PE expansion, what you've seen is a currency depreciate and a revenue outlook improve. And the result of both of that has been substantial earnings upgrades over the last 4 or 5 months. So much of the stock movement that you've seen, I would attribute to the earnings upgrades. Yes, there has been some hint of PE expansion as well. And the PE re-rating has been more in line with improved revenue outlook for the future. And that's very consistent with what's happened in the past. So nothing extraordinary, I would say. Now, will PE re-rating continue? I think it's wrong to have a broad brush. Someone like TCS is already trading at higher end of its historical range. So seeing any incremental re-rating there is going to be difficult. Yes, a couple of stocks like Infosys and HCL, there is some propensity for re-rating from current levels. And that is contingent on revenue growth coming through. So there is some chance out there.
Nimish, hi, afternoon. How much upside do you expect in Infosys, and does senior management exits worry you?
Yes, of course, top management exits do worry me. Maybe some of these are planned exits. Company wanted those exits to happen. Some of those are unplanned. So it's difficult to put a finger, but I think it's a mix of two. Now, the thing is, these exits, the impact of these, you will see probably 6-9 months down the line. You won't see it impact in the next 6-9 months, because what business you are going to see in 6-9 months is a function of whatever work was done in the previous 6-9 months. But yes, there is an element of worry. And top management at Infosys hasn't really been stable in the last couple of years, ever since the transition to Mr. Shibulal has happened. There have been some exits. There has been continuous change in responsibilities of senior managers. And that has impacted performance, as you have seen. Now, last couple of quarters have been good. There seems to be some semblance of stability on the revenue front. Maybe over the next 6-9 months, I expect that to continue. The exits might not impact as much. The big positive surprise, if at all, you will see, I think, will be on the margin side. Again, for the last couple of years, performance, if you see, Infosys has dropped almost 600 basis points in margins. Peers have been stable, or someone like HCL Tech has even improved. So I think what's going to happen is Infosys will recover some of those lost margins, maybe not the 600, maybe a couple of 100 basis points. And that could drive some outperformance in the stock over the next 6-9 months.
Nimish, you did speak about HCL Tech. Now, despite commendable performance, investors still don't seem to be convinced of the HCL Tech story, and it's partially reflected in the PE that it attracts. You think there is a case for a re-rating on HCL Tech?
Yeah, that's right. I won't say I think it's wrong to say investors are not convinced. Probably people are not convinced whether this will sustain or not. And there are two aspects to that. One is, if you see, earlier this year there was a change in the CEO. Now, Vineet Nayyar was a very dynamic CEO, very charismatic CEO. And whenever a change of guard happens from a very charismatic CEO and whoever succeeds him, there is always this doubt in the minds of investors, which is what the stock is going through right now. Probably had Vineet been CEO today, the PE would have been much higher than what you are seeing in the stock today. So that's one aspect. Second is, last year and a half, growth in HCL Tech has been concentrated pretty much in the infrastructure services business. Now, to be fair to them, that has been true for most other companies as well. But just that out of infrastructure, the growth hasn't been much high. So probably there is a worry around sustainability of this growth, rightly so. I am not as worried, because when I look at the market dynamics, I see infrastructure constitutes 50 to 60% of the deal pipeline for everyone in the market. And HCL has been traditionally strong. So over the next year or so, I think HCL Tech will do middling growth, middle end of peers. And again, the key delta at HCL will be margins. They have done a fantastic job over the past 18 months, and I expect them to continue to surprise the street on margins. So these two aspects probably will continue to help HCL stock perform. And add to that, as you just said, the PE is not at all demanding. it's at a much bigger discount to peers. So I think HCL should also do well.
So what about TCS then? Can it continue to have industry-leading growth?
See, TCS is an industry bellwether. It has had a very good run over the past 3-4 years. The valuation zone that TCS is currently into, the expectations that the investment community has from TCS, and the high growth expectation and the ownership, everyone owns TCS. In this backdrop, for TCS to really deliver absolute return in the next 6-9 months is going to be difficult. So I expect more a consolidation phase for TCS over the next 6-9 months. Now, if you're an investor with a 2 to 3 year horizon or even longer, then I am recommending TCS, because leadership is stable. They have cracked the model very well geographically diversified. So in terms of growth, it will continue to lead the peers. In terms of margin, it will continue to be high. But in stock market, you need to also see where the expectations are. That is why probably over the next 6-9 months, it might not be the best stock to own.
What about Midcap IT, Nimish? Any companies, stocks that you like in the Midcap universe?
See, Midcap IT, our focus primarily has been on large cap. We continue to maintain that. Midcap IT, it's more driven by the currency. And you see, whenever currency depreciation is there, these stocks continue to outperform. So if one has a view that depreciation will continue, then obviously you could take picks like Persistent and Mindtree, who are much higher leveraged to the currency. Otherwise, I would probably stay away from these names.
So coming to environment, what is it that your channel checks are telling you? Is discretionary spending now picking up?
See, clearly the mood seems to be better than what it was 6-9 months back. It's not just the data points, economic data points, but if you were to talk to the companies, they themselves say that deals which were stuck in the pipeline for 4-5 months are moving ahead, decision making is happening. Now, if I were to use that as a barometer of demand, then definitely there has been a positive delta on the demand side. On the discretionary spend, but I am not so sure. I think the demand that we are seeing today is still a cost containment type demand. Discretionary, the traditional discretionary spend meant big ERP implementations, SAP, Oracle implementations. I think what seems to have happened is those are not at all there in the market. And that could be part cyclical because of the economy, and part secular, because if you see the likes of Salesforce and Workday are outselling SAP and Oracle in certain parts of the business, and at some point of time that is going to have a negative trickle down impact on IT services businesses as well, which is what I believe. But if you see commentary from some IT companies, they are saying discretionary spends are back, but the definition of discretionary spends has changed. Everyone is now talking about digital mobility, social analytics. Those kind of discretionary spends are there. There are hundreds of $100,000 projects, but I won't classify that as true discretionary or the discretionary in the traditional sense of the term.
Okay, Nimish, really good chatting with you, and really appreciate you taking the time out and speaking with us.